One of the most common questions in financial planning is, what is your risk tolerance? It appears on questionnaires. It drives asset allocation models. It is used to justify portfolio construction decisions worth hundreds of thousands of dollars. And it is almost always measuring the wrong thing. Risk tolerance questionnaires ask how you would feel if your portfolio dropped 20%. They ask whether you would stay invested or sell. They ask you to imagine volatility and predict your own response. The problem is that humans are reliably bad at predicting how they will feel under conditions they are not currently experiencing. Research in behavioral economics consistently shows that stated risk tolerance, what people say they would do, diverges dramatically from revealed risk tolerance, what people actually do when the loss is real and the fear is present. In other words, you do not know your risk tolerance until the market tests it. And by then, the damage from misjudging it is already done. What most risk tolerance questionnaires are actually measuring is emotion tolerance, your capacity to sit with discomfort, to hold a position when everything in you wants to move, to trust a process when the process is delivering pain. Epictetus taught that the untrained person is moved by circumstances. The trained person moves through them. The difference is not the circumstances, it is the preparation. Here is the practical implication. Your true risk tolerance is probably higher than you think in bull markets and lower than you think in bear markets. Most people have exactly the wrong relationship with risk. Overconfident when prices are high and assets are expensive, panicked when prices are low and assets are cheap. The Stoic solution is to design your portfolio for your actual emotional capacity, not your aspirational one. If a 30% drawdown would cause you to sell, then a portfolio that can drop 30% is too aggressive for you, regardless of what the models say about long-term expected returns. The expected return is only captured by investors who stay. If you will not stay, the model is wrong for you. Build the portfolio you can hold, not the one that looks best on a spreadsheet. And then, separately, systematically, work on your emotion tolerance. Read the history of markets, study the pattern of recovery, train your nervous system to recognize panic as a signal that an opportunity may be forming rather than a command to act. Risk is not the enemy. Unexamined emotion is. I will see you in the next one.